You've probably heard the whispers, the headlines, all this talk about a new no tax on overtime law. But what's the real story for your bank account? Let's dive in and figure it out. So, this is the million-dollar question, right? Does this new law mean all those extra hours, all that grind, is now completely tax-free? Let's get straight to it. Okay, the short answer is no, it's not completely tax-free. But hold on, don't go anywhere, because this is still fantastic news that could literally put thousands of dollars back where it belongs, in your pocket. We just need to understand how it really works. So here's our game plan for today. First, we're gonna bust that no-tax myth. Then, we'll figure out if you're eligible. After that, the fun part, calculating your potential savings. Then we'll give you a simple 3-step action plan, and we'll finish up with some quick-fire questions. All right, let's start with the most important bit, what this new law actually does. It's not about what you see on your weekly paycheck, it's all about what happens on your tax return. So the official, kind of boring name for this is an above-the-line deduction. But what does that even mean? Well, think of it like a special coupon you get to use on your total income before the government calculates what you owe. It lowers your income on paper, and a lower income means a lower tax bill. The key thing to remember, you see this amazing benefit at tax time, not on your paycheck. And here's a really crucial detail. This law isn't permanent. It has an expiration date. It only applies to the tax years from 2025 through 2028. So you're definitely going to want to take full advantage of this while it's here. All right, let's get personal. The big question, do you qualify for this awesome tax break? Let's go through the checklist and see if you're on the list. To qualify, you've got to tick 4 boxes. First, pretty simple. You have to be a U.S. tax filer. Second, you need to be something called an FLSA non-exempt employee. Don't worry, we'll break that down in a sec. Third, you had to have earned that classic time and a half overtime. And fourth, your income needs to be under a certain limit. So let's look at who's generally in the club and who isn't. If you're an hourly worker or non-exempt staff, you're likely in. But if you're a salaried manager, an independent contractor, or you work for yourself, unfortunately, this deduction doesn't apply to you. Let's tackle that term, FLSA non-exempt. It sounds super technical, right? But for most people, it's simple. It just means you're an hourly employee who, by law, has to get paid 1.5 times your normal rate for any hours you work over 40 in a week. And finally, the last hurdle, the income limits. To get the full deduction, your income, or what the IRS calls your modified adjusted gross income, has to be at or below $150,000 if you're single. If you're married and you file your taxes together, that number jumps up to $300,000. If you earn more, the deduction starts to shrink. Okay, so you've checked all the boxes, you qualify. Fantastic. Now for the really exciting part. How much can you actually save? Let's talk numbers. Get ready for this. If you're a single filer, you can deduct up to $12,500 in qualified overtime pay from your income. That is a huge deduction. And it gets even better. If you're married and you file a joint return, that number doubles. You can deduct up to a whopping $25,000 in overtime. Seriously. So what does that deduction actually mean for your tax refund? Well, look at this. A single person in the 22% tax bracket could save $2,750. For a married couple in the 24% bracket, that's a potential savings of $6,000. That's real cash back in your pocket. So you know you qualify and you see the potential savings. The next obvious question is, how do you actually get this money? We've broken it down into a super simple 3-step action plan. Step 1 is to confirm. Just pop over to HR and ask, hey, am I an FLSA non-exempt employee? Step 2, track it. And this is so important. Keep every single pay stub. You need them as proof. And finally, step 3, claim it. When you do your taxes, whether you use software or a person, make sure you claim this deduction. We are in the home stretch now. Let's wrap things up by running through a few quick questions to clear up any last bits of confusion. Okay, this is probably the number 1 question we get. Does this new deduction mean your job is going to stop taking taxes out of your overtime paychecks from now on? And the answer is a very clear no. Your employer is going to keep withholding taxes from every single paycheck, overtime included, just like they always have. I'll say it again. The benefit, the magic, it all happens later on your tax return. Here's another great one, especially with tax season upon us. What about all that overtime you worked last year, back in 2025? Can you claim that? And the answer is yes, absolutely. The law is retroactive, so it kicks in for the 2025 tax year, which is the return you're probably working on right now in 2026. So yeah, time to start digging up those 2025 pay stubs.
Okay, before we finish, our standard disclaimer. Remember, this is all for educational purposes. We're not tax advisors, so for your specific situation, you absolutely should talk to a qualified tax pro or visit irs.gov.
So, we'll leave you with this final thought. You know how it works, you know who qualifies, you see the potential impact. The only real question left is, how much could you save? Time to go find out.